We are thrilled today to welcome New York Times best-selling author Beth Kobliner. She's joining us to talk about financial issues that are relevant for college-age students. She's one of the nation's leading authorities on personal finance for young people. She's been a columnist and contributor to major magazines and newspapers throughout the country, including the Wall Street Journal, Money, and Glamour magazine. In February 2014, she was appointed by President Obama to the President's Advisory Council on Financial Capability of Young People.
Thank you so much for coming this morning. This is not information that young people learn. It sounds overwhelming, but there's some basics. Do a smart job search and use your resources wisely. One of your best resources is the Mercy College Career Office. So my dad had a very creative idea, and I'm gonna share it with you guys. What he did was he said to comb through, in addition to going to the college career office, you know how there's an alumni online magazine? Go on it, and what my dad did for me, back they didn't have online, it was an actual magazine, and we combed through like the last couple of years worth of magazines, circling any job that sounded kind of interesting that an alum from my college did. And I looked at Mercy College's website of alumni, and so many alums from Mercy College who write into the magazine or the website, and remember, people who are writing in love the school, so they'll be more willing to talk to a recent grad. There was a family therapist who wrote a New York Times best-selling book. There was a researcher on autism who spoke at Oxford. There were many principals, many firefighters, police officers, police captains, someone who worked at the White House. I mean, it was very impressive, the list of alums. So I highly recommend you do that. And don't flake out. If a friend, your parents ask your parents' friends, relatives, anyone, if they say, hey, I know somebody at the local bank or something, or any kind of job that sort of sounds interesting, but you're not sure if it sounds interesting, go anyway. They may be friendly and offer you a tip on your resume. There's a typo there. And those things really matter. When I look at resumes for, editorial assistants, seeing a typo, you're like, okay, this person didn't take the time to just proofread this. So little things like that, and again, your college career office can help you with that. Pay your student loans on time. So when you graduate, suddenly you're gonna have to start paying those loans back at one point or another. And studies show most grads have no idea where their student loans are or even how much they owe. With the federal student loans, you can go to the National Student Loan Data System. It's nslds.ed.gov. And it's the website that will tell you exactly what you owe. Even if you're a freshman, you might want to be like, oh, how much do I owe? And it'll give you who you owe, who your loan servicer is, the person you have to deal with when you pay it back, what interest rate you'll pay, just so you know. It's good to know that information. It sounds scary, but it's better to know. So when you graduate from college, the standard is you get 6 months before you have to start paying back, and then you start paying back, and they have you pay back over 10 years. But if you want to, you can pay faster than that. But if you can't make those monthly payments at first, they have all different kinds of programs. They have something called income-sensitive repayment, where if you go into a maybe lower-paying job, they'll say, okay, you can't afford that monthly. We're going to allow you to make a lower monthly payment, which can be really helpful. And once you have more money, you can start paying more back. The 10-year repayment plan is the best because you pay it off, ideally, or even faster than that, and you pay less interest. But if you have to do the income repayment plan or stretch it out over 20 years and pay smaller amounts, that's okay. Because again, we're talking about very low interest rate loans. And if you're a teacher or a nurse or work for a nonprofit or the government, you may qualify for what's called public service loan forgiveness, which basically means that if you work in one of these fields and if you qualify, the government forgives your loans completely after 10 years, which is a good thing. When it comes to student loans, the most important thing that everybody should listen to and not forget, don't miss a payment. One missed payment, it's like, I missed it. One missed payment will stay on your credits record for 7 years. And it's so much better to sign up for some sort of automatic payment plan where they funnel the money out of your, I know it's hard to even making enough money to do this, but when you graduate and you get some sort of job, you'll have the money taken out of your checking account on a regular clip, and it'll be something that's affordable to you, but you don't want to miss that payment. Get health insurance. Right now, you're probably covered either by school or your parents, right? But when you graduate, it's very important to make health insurance a financial priority for a couple of reasons. The number one reason people go bankrupt, there's a sense of, oh, they shop too much and they buy cars, but actually the number one reason people go bankrupt is because of healthcare costs, like somebody, whether they're young or old, has a terrible accident or gets very sick unexpectedly, and that could be so expensive not only for you, but also for your parents. So it's very important to have health insurance. The good news is probably a lot of the jobs that you're looking at offer health insurance. That's a huge benefit, obviously, as you're looking for jobs. Health insurance now is in the news so much more, and I think the advantage of that is people are realizing that they really need to get it, even if you're young, because I know it's so hard. You're young, I have student loans, and I have credit card debt maybe, and we'll get to that in a second, and I want to live out on my own, but having health insurance is really another priority. Do not get into credit card debt. The good news for your generation is that you have actually much less credit card debt than my generation did when we were graduating, and I think it's because you've seen what happened in the recession, and you're more careful, I would think. The average rate on a credit card is about 18%. And getting a credit card is basically getting a loan. When you get a credit card and you use it to pay for something, and you don't pay it back right away, you buy something, $100, you're like, I'll just pay the minimum. That is a very, very expensive loan. That's an 18% loan. Whereas your student loan, for example, is probably closer to 4%. It's very expensive. And as we all know, it can add up very quickly. If you have any savings, or you're starting to get more savings, I would say use your savings to pay off your credit card debt. So here's just the math of it really quickly. Say you owe $1,000 on your credit card, that's charging you 18%, right? Stay with me, this will be easy. 18%, $1,000. At the end of the year, you pay $180 out in interest, right? So it's 18% of $1,000. If you have $1,000 sitting in a savings account paying you only 1%, at the end of the year, 1% of $1,000 is you only get $10, right? So at the end of the year, you'd pay out $180 in interest on the credit card, but you'd only take in $10 in interest from the savings account. So you basically have a net loss of $170, right? If you take that $1,000 and use it to pay off your credit card debt, you break even. You don't earn any interest, but you don't pay out any interest. And it's so much better to break even than to owe $170. And if you can't get rid of it, at least call the credit card company and say, you know what? I'm a junior, I'm a senior in Mercy College, and I like your credit card, but can you give me a lower rate? And most of the time, they will lower your rate. Or if you say, I'm thinking of switching to another card, and there are two websites, bankrate.com and cardhub.com, and they list the lowest rate credit cards. So you can consider transferring, and make sure you know what the fees are, but you can transfer your high rate debt, hopefully, to a lower rate card. I definitely think freshman year is young to have a credit card. You don't even need one sophomore year. Maybe because the key is if you need money, you only can buy stuff. Now I'm talking about the extra stuff, right? Because you have your tuition covered. The extra stuff, only buy that extra stuff if you have cash in your wallet or if you have the money in the bank. The good news for your generation is you're aware of that. Like if I were here 20 years ago or even 10 years ago, the feeling was, I have my bank account, I have a checking account, and I have a credit card account. And I just use that card just like I would take money out of my savings account. There wasn't a distinction between, no, the credit card's a loan. And I think that's really where my generation got a little more tripped up. And credit was so easy to get, and credit cards, and you got one freshman year, and there are people on tables, like you walk out there, just sign here. Credit cards are fine. Use it as convenience. You don't want to carry $100 in your wallet, so you use it and then just pay it off as fast as you can. So more people, particularly at your age, but even my age, which is kind of weird, know their SAT scores better than their credit scores. Credit scores are basically just a score on how well you do at paying your bills back. So if you make your student loan payments on time, you pay off that credit card regularly, or even if you don't pay it all off, but you absolutely make the minimum payments that you owe, that will mean if you make those on-time payments, you will have a good credit score. And the range of credit scores is anywhere from like 300 to 850. It's almost like the SATs. It's so weird. But the average in the country is about 700. So you can all go on creditkarma.com to see what your credit score is, if you have a credit score. And the number one predictor of what gives you a good credit score is paying your bills on time. Like I said, one late payment could end up costing you, would end up with a much worse credit score. And when you have a lower credit score, if you go to apply for, say, an auto loan or one day a home loan, they might say, well, you don't have a good credit score, so we're going to charge you a much higher interest rate, right? So instead of charging you 10% or 8%, they'll charge you 15%. And that, it's a few percentage points. It doesn't sound like that much. That could be tens of thousands of dollars on a home loan. Some people think that, if I have a credit card, it's better to only make those minimum monthly payments because I'm building up credit. That's not true. It's better to pay off your balances in full each month. When you start having income, when you graduate and have a job, or even if you're doing pretty well, you have some student loans and you worked over the summer and you made some money, open what's called either a Roth IRA, or when you start your job, make sure to know if they have a 401k. So now all of your eyes are going to glaze over because these are called retirement savings accounts. And the idea that you're, in your 20s, maybe 19, 18, and to think about retirement seems crazy, but actually it is so. If there's one thing, now I said to pay your bills on time, that's really important, but honestly, if you walk out of this room, here's the one thing I hope you all learn. Open a Roth IRA when you're very young, or if you work for a company that offers a 401k. And the reason is they're called retirement accounts, but they're really super smart savings accounts. When you put money in either a Roth IRA or a 401k, your money grows tax deferred or tax favored. In some cases, tax free. This is a legal, very honest way to not pay taxes, and you put that money in there and it grows very quickly. Apparently Einstein called it the eighth wonder of the world. So when you have money in a bank savings account, say you earn $50 in interest that year or $10 in interest, you have to pay tax on that. So maybe you really only earn like $6 in interest because you pay tax to the government. But when you have money in like a Roth IRA or 401k, you have $10 in there, and next year you have $10 and you never pay tax on that interest. But not only do you not pay tax on that interest, the next year you don't pay tax on the interest earned, and you don't pay tax on so it's like on and on and on, so it grows exponentially quickly. So it's not just important how much you put away, but how early you put it away. So if you walk out of here, remember the one thing she said was open a Roth IRA or a 401k. And 401ks at work are great because they often have matching. For every dollar you put in, they'll put in 50 cents or $1. That's free money. Don't buy a new car, buy a used car. And don't lease a car. Leasing a car is a ripoff, typically. And the average car, the typical car costs now about, new car is $34,000. The minute you drive that car, you pick up that $34,000 car, like we're imagining, you go, $34,000, you drive it off the lot, it loses immediately $9,000 in value. Because cars, once you drive them, they're a depreciating asset. And the minute you drive it, don't buy a new car. Buy a used car, But before you buy it, there are two things to do. Go on carfax.com, it's F-A-X, carfax.com, and for $40, they'll tell you if the car has been, had accidents, that particular car. Has it been recalls? Have there been problems? So you can find that out. And also, what you should do is have an independent mechanic check it out. If you get a car loan, go with the shortest term you can. Now they're offering car loans. You want to pay your car loan back in 3 to 5 years? They're offering car loans for 7 years, 8 years. By the time you pay off that car and you're ready to sell it, you're going to owe more than it's actually worth. When you graduate, say to yourself, no matter what job you have, what income, save, it's going to sound hard, 15% of whatever you take in. 15%. And that's, of course, not a magical number, but starting up front with that, you're basically just pretending you're earning 15% of whatever your salary is. And you get into the habit, and you could do it automatically. You could sign up from your bank or an investment company and have them automatically take that money out of your paycheck from the start. Probably the third smartest move you can make when you graduate is live at home with your parents. Oh my goodness, this was, I did it for a year. Here I was, I graduated from college. I know, but my daughter's a junior. I would do anything to have her move back home. No, but it's such a good way to save money. When I graduated, I said my first job, I was working, I lived at home, and I just put basically as much of my paycheck that I didn't have to spend on, I didn't have to really pay for food too much, and my mom helped me with my laundry, all those things that cost so much money, and you learn that in college, right? If you're not commuting from here, if you live here, that it's very, very, very expensive. It is a great investment, and I won't tell your parents that I told you to do it for the money. You just tell them, I missed you guys. I'm gonna live at home for 1 year. Once you open that Roth IRA or 401k, you have to figure out where to invest that money. You have to make a choice. And with a 401k, they give you a menu of choices. And with an IRA, you have to make that choice yourself. And my advice is to open what's called an index mutual fund. It's not one stock, but it's made up of hundreds, if not thousands of stocks. So it's called, they say, diversified, right? Some stocks may do really badly, but other stocks may do well. So you have like an average of, you're not the one stock that did great, but you're not the one stock that tanked. You get an average. So have you heard of like the S&P 500 index or the Dow Jones Industrial Index? You've heard those names. These are basically just baskets of stocks that serve as a barometer of the stock market as a whole. So there are thousands and thousands of stocks in the stock market, but the S&P 500 index is a group of stocks that are basically the 500 largest stocks in the stock market. There's the actively managed, where the manager's picking and choosing, or the passive, where you're just investing in the S&P 500 index fund. So the answer is that over time, studies have shown that these index funds do just as well. These index funds, the passively managed ones, do just as well as the actively managed one. And the question is, why would you pay more money for something that doesn't do any better than the passively managed index fund? And the answer is you shouldn't. What could a college student do now to be financially prudent? It seems like you all know, first of all, that absolutely you get federal student loans before private loans. The difference between a federal loan, which is what all of you have, federal loans and private loans, is so important, is so good in your favor because the interest rates are low and there are all these repayment plans. So if you're still taking out loans, steer clear of the private loans. Don't get into credit card. I said that. And, save as much as you can over the summer. It's hard. I understand that. But avoiding credit card debt really is the thing at this point in your life. Just being mindful of these and not worrying about it. I mean, I know I've given you a lot of information, but frankly, Mercy College has, I think, one of the lowest tuitions of any private college in the country, which is awesome. Paying attention to these things, I think at this age, you don't have to obsess over it, and that's why I like things like index funds or 401ks and signing up automatically because you sort of do it, and then you don't have to worry about it so much. It doesn't have to be your whole life. You don't even have to really like it that much. You just sort of set it up quickly, and then you kind of let it happen, and you know what to be mindful of.